What's up everyone, my name's Robbie, this is Robbie in Manila, and today I'm translating CNBC. So back in college, or maybe even as far back as high school, I developed this perception about CNBC. I associated CNBC with a select group of people, and these are people who understand finance and business and the markets and investing, and I thought to myself, maybe if one day I was to understand what they're talking about on this channel, maybe I'll be able to one day also be in this select group of people. And back then I thought that being part of this group would mean that I had the knowledge that you need to build wealth, and that I guess one day I would become wealthy because I know what they're talking about on CNBC. And now I know that if you follow CNBC and you know every single thing they're talking about, it doesn't necessarily mean you're going to be wealthy. I know people who follow almost every single thing that they're saying on CNBC on a daily basis, and they're definitely not wealthy. And honestly, I know wealthy people that probably wouldn't understand 95% of what CNBC talks about. But at the end of the day, I'm sure you would like to know more about the lingo that they talk about in CNBC, and then generally, it'll help you understand the overall markets. So I'm gonna play a few CNBC clips, I'll translate them for you, and then hopefully at the end of this whole thing, CNBC won't seem like such a foreign language. So let's go ahead, let's get started. Okay, before we begin, there's a button. It's down there on your screen. Just look, it looks like a thumb. Please hit the button. That would really appreciate me. I would appreciate that. Okay, so the first clip we have is from Bob Pisani. He's talking with David Nadig of ETF Trends and Nicholas Colas of DataTrek Research.
Volume in a lot of these big ETFs today. Joining us to discuss, Dave Nadig from ETF Trends, Nicholas Colas from DataTrek. Dave, the heavy volume is coming from several directions today. Tech-oriented ETFs, the robotics ETF.
Okay, let's already start with what he's talking about here. So you hear this a lot on CNBC. They talk about ETFs. So an ETF is an exchange-traded fund. It's basically, think of it like an index fund. You might know what that is, you might not. But an example of an ETF would be, let's say, something that tracks an index. So you might have heard of the S&P 500 index or the Dow Jones Industrial Average. So an ETF might track how an index moves. So for example, let's say the S&P 500 index, which is 500 of the largest stocks in the US. So let's say that all of those 500 stocks on average go up by 1% during the day. Well, that ETF is also going to go up 1%. So you can invest in this ETF and your money will move the way that the index moves. Same with if the market goes down. If the market loses 0.5%, your ETF should also lose 0.5%. Now, some people don't understand the difference between an index fund and an ETF. So just think of it like this. An ETF trades on the actual market. So you can buy and sell them during the day. And that's good for people who like trading. So traders might always buy and sell ETFs during the day in and out of positions. You can't do that with an index fund. So an index fund is going to be a longer term position, at least not a daily in and out type thing. So you might own an index fund passively and put money into it every month and hold it for years. Or you might just hold it for months or maybe even weeks, but that's kind of the difference. So when they're talking about ETFs, they're really talking about exchange traded funds, and then sometimes they're talking about it in a trading methodology. So let's keep seeing what Bob says.
ETF, semis, lithium and batteries, momentum ETF.
Okay, so semis, lithium, and batteries. So these are different types of ETFs. So ETFs can track certain sectors or certain markets. He said momentum ETFs. So a momentum ETF is going to be an ETF that invests in stocks that have high momentum. So, and momentum being, let's say, lots of volume. They're making big increases and decreases in price. So these are different things that they're talking about.
All off of the lows, but down on heavy volume. Also cyclical names associated with the reopening down on heavy.
Okay, so cyclical names, when you hear that, think of companies that sell their products in cycles. So some companies, like let's say oil and gas, might have more revenue in certain times of the year than other times of the year.
And the oil, metals, airlines, banks. Dave, is the reopening fizzling here?
Yeah, I mean, I think this is what's happening. As the reopening is fizzling, we're starting to bring some reality back to some of these names that may have run too long. You look at what's working at things like materials. I think we got a long way to go before we can really get a rally until we can find a bottom in some of these names that ran so hard.
Yeah.
So you might not even know what a rally is or the bottom. So when they talk about a rally, they're really talking about a increase in stock prices. So a rally might be when a stock or a basket of stocks, maybe an index, has a large increase in value. And a lot of times this also happens with volume. So there's a lot of people buying, so there's a lot of volume.
You know, Nick, despite today's action, other parts of the market are holding up a lot better than tech and banks, like materials.
Okay, so another thing that they all a lot of times do on CNBC is they look at the market and they break down the sectors of the market, the industries. So here they're talking about the sector ETFs. So we kind of went over ETFs already. And then they're talking about what's going on within these different ETFs. So sometimes, and maybe you know this, maybe you don't, the tech sector may have huge gains, but the other parts of the market might not. So in a situation like that, you might have a bunch of companies that don't make any money, but tech makes tons of money. And that actually can bring the whole market up with it. And so you might look at the S&P 500 or the Dow Jones Industrial Average, and you might see these different, the different sectors within these indexes. It might be actually misleading. So a lot of times they talk about which of the sectors are gaining and not gaining, and then that way, if you're trading or if you're just trying to invest in very specific things, it can help you try to figure out where to put your money.
Some of the industrials for the month, but both tech and banks are down big in September. I'm wondering, how long can you really keep a rally or get off of the lows here when tech and banks are not contributing at all? They're not bouncing.
Okay, so what Bob's saying is, how do you get off the lows when tech and banks aren't doing anything? So, at least where we are in the market right now, the tech industry has made huge gains, and really, it's moved the market. So a lot of other sectors have not had any near gains like tech. So if tech's not moving, then how are we going to get off the lows, is what Bob's saying. You need tech to also get off these lows, because tech's the main industry or sector that's actually moving right now.
Yeah, that's right. I mean, tech and banks are 37% of the S&P 500, and the big...
So if you take the S&P 500, the top 500 largest companies, based on market cap, but we won't get into that yet. So just think of it like the top 500 largest companies. That's a huge percentage of the sector is tech and banks. So of course, if tech, because it's a large part of this index, if tech has big increases, so too will the S&P 500. Just think of it like this. If the S&P 500 was 99% tech stocks and tech had big gains, of course, there would be large gains in the S&P 500 because it's a large part of the index.
5 tech names are 22% on their own. So that and correlations rising during periods of volatility.
Okay, correlations rising during periods of volatility. You'll hear a lot about correlations. So stocks might correlate with each other. They might correlate with other asset classes. So think of it like this. Let's say a tech stock maybe doesn't correlate with a utilities company, but maybe in times of like euphoria, everything goes up. So maybe tech and a utilities company would actually correlate similarly. So a non-correlating asset would be, let's say, a bond. Maybe a bond loses value when a stock gains value, just in general, right? So if you have different asset classes, let's say stocks and bonds, they shouldn't correlate 100%. A stock, if the stock market goes up 10%, bonds shouldn't gain 10%. They shouldn't correlate together. That's what he's talking about. Okay, the next clip we're gonna watch is from the Fast Money halftime report. This has got Scott Wapner, by the way. Scott, USF, University of South Florida grad, just like me. So, like Scott. By the way, they call him the judge. For a while, I didn't understand why, and I'm pretty sure it's because he's the host, the moderator, the judge of the show. So anyway, you'll hear people call him Judge on the show, and you're like, what? Is that his nickname? But I think it's because of his position. Also in this is Pete Nigerian and Josh Brown. Downtown Josh Brown. That guy's a character. I like that guy. So okay, let's go ahead and let's watch this clip.
I see on Twitter now, Starbucks says August U.S. comp sales growth for the company-operated stores was negative.
Okay, so you're probably already confused. U.S. comp sales growth for August, I think that's what he said. So comps. So when someone says comps, they're usually going to be referring to something called comparable same-store sales. So actually, I think I first learned about this in high school when I worked at the Gap. And so I was working at the Gap, and I was actually surprised that they were looking at the sales from the previous year. And so I was thinking, like, I'm in high school. I'm like, wow, they actually track how much money they made the previous year, and we're trying to hit those same targets. So that's what he's talking about. Same store sales and comparable. So he didn't say what they're comparable to, but likely it's comparable to August last year.
11 during the month of August here in the United States. August comp sales growth in China for company-operated stores was 0.
So he's talking about comparable same-store sales growth. So whether or not Starbucks, for example, which is what he's talking about here, is Starbucks growing its sales in its comparable same-store sales? So if it's 0, that means that sales aren't up from the previous year. And, you know, they should be, because Starbucks is expanding and they're trying to make profits and maybe increasing prices and doing all sorts of stuff. And you would think in a capitalistic society that it would increase.
I mean, the stock was about 1.2% or so before I noticed that. Stock's getting a little bit of a lift on this news. Maybe the fact, Pete, and I don't know, we're looking right now to see what July comps were, both in China and the U.S. for Starbucks. You just sold your Starbucks calls. You closed out that position.
Yeah. Okay, so you'll hear this a lot of times too when they're talking on CNBC, a call. So a call is a type of option. And so Scott said you sold your calls, but then he said you closed your position. And so he basically, what he was doing is he was clarifying, because you can actually sell a call. That's a type of option. It's an option contract. So you can sell a call option. And so that's a bearish play. If you buy a call option, that's a bullish play. You think the stock will increase in value, so you're buying a call option. So he was basically, interestingly enough, so that might be something that you now will understand. He clarified by saying, close the contract, instead of saying you sold calls, which was the right way to say it.
But I'm wondering what you make of this news. China is obviously a significant part of the growth story for Starbucks. So if that is at the worst stabilizing and at best improving even incrementally, maybe that's a positive for the stock, and that's why it's reacting, albeit slightly.
So okay, they're trying to gauge whether or not the fact that with everything that's been going on in the world, that their same-store sales, comparable same-store sales, is flat. So there's not been growth. That might be good, because that means with everything that's been going on in the world lately, they haven't lost much money. So they're trying to gauge if that is going to be good for maybe, let's say, sentiment for this stock going forward, or at least in the short term.
Yeah, and I think the expectation was we're going to see better numbers, some stabilizing numbers, as you put it, for China. So I think that's something that is built in. Here's the story.
So Pete thinks that they should have had, or that the market expected to have better results in those comps. So he's saying maybe because they aren't going to get exactly what they thought, it's going to not have such an effect on the stock.
For me right now, Scott, when I look at this name, I love the name. I think they do most everything right. But I also think the reality is the stock gets really heavy when it starts getting up towards 90. So I think...
So that's just kind of a way of just saying that the stock is hitting, maybe it hits resistance around the 90 price. So let's say Starbucks, it says right here, it's trading at 88.5, $88.50. That's what the stock is trading for. So if the stock is getting close to 90, Pete says that it gets heavy up there. It's hard to kind of break through that, what you would call resistance level.
It's a great buy on every dip that we've had and an opportunity towards 80. I think that's great. But when we get towards 90, it has a very difficult time. So I just look at this one very much like I've looked at Walmart in the past in terms of at the PE levels, there are times I think that are a great opportunity.
So PE ratio, PE levels, meaning price to earnings ratio. So he's basically distinguishing that at a certain PE level, he thinks that it's possible that it could be a buy or not a buy. It could affect his ability or his decision making on whether or not a stock should be bought.
That give us that opportunity to buy, and I think there's other times that I need to exit. And I think in this case, as it approaches 90, I just decided I need to be out.
Josh, you mentioned this in part of your notes. We talked about it at the very top of the hour, and I'm trying to get more context for everybody on what exactly these numbers mean, specifically relative to what they were in July, so you have a better idea of where the story is moving as we move forward. But what do you think of Starbucks here?
By the way, Josh Brown, downtown Josh Brown. This guy cracks me up.
I love it. I think Pete has it. I think Pete has it upside down. The stock has been up to the 90 to 95 level twice. Last summer of 2019, and then in January.
So Josh has a different opinion than Pete does on this. So this is what you get a lot of, and this is why CNBC is kind of good. You get all these different opinions, and so of course investing isn't all facts and stuff like that. It's really based on sentiment and what you think and what you see in the past charts and where do you think it's going. So, two different people having two different opinions on Starbucks. Really, it's just about Starbucks at these levels too. So we're only talking about a small price area in the 80s to 90s, let's say. So they're not talking about Starbucks, whether or not it's a good company, if it should be worth $150 a share. It's really just, should it be worth another $10 from where it is now?
And when it breaks above this time, which I think it will, there'll be no resistance and no one left to sell. There will be no shareholders in Starbucks.
So when it breaks resistance, meaning that he thinks it's going to break above what he thinks is resistance, I believe they said 90. So they think if Starbucks goes from, let's say it's at 88.50 right now, if it goes and breaks through resistance, which might be 90, so let's say it goes from 88.50 to 95, well then it clearly will have broken the resistance. And so Josh is saying if that happens, there might be room for more growth.
Who have a loss, and that to me just looks like miles of green field. So I don't suggest that breaking through the $92 resistance level will go quickly or will be easy, or maybe it will. They report in October. But at the end
So basically I said 90, apparently he's saying 92, and they report in October, meaning they will report their earnings in October, which is a time where a lot of movement happens with stocks. So when new things come into the market, so new data, new earnings, new news, that's a lot of times when, in the short term, stocks will move. So that's all we have for today's video. Thanks everyone so much for watching. I hope you enjoyed it. I hope it kind of helped you now understand a little bit more about CNBC and the markets and investing and things like that. So if you like this video, please hit the like button. It really helps me out when you hit that button, and then subscribe if you want to see more videos kind of like this. This is my first one of these, but maybe I'll make some more if you liked it. And so thanks again, and why don't you hit the next video on the end screen that's coming up right now.